actually want to keep pulling on that sort of like reflexivity thread a little bit, Scott, right? It's going to, when you have people pouring money into a space, it's going to impact the underlying market itself. I would love, and either of you please comment on this, to get a better picture of if this trade continues to grow, what do you think it would do to things like skewness? What do you think it would do to things like the VIX term structure? Would we expect structural changes as long as this trade remains as big as it is, or continues to get bigger as a complex?
Yeah, I mean, I would say that, first of all, this trade, it's certainly not just this this one particular thing that JP Morgan is doing, right? It's a whole complex of selling volatility, relatively near the money upside. For example, call overwriting, which, as Scott Maidel pointed out, right, has become wildly popular among big institutions, and it has had a huge impact, right? I mean, one nice thing, right? When you think about factor investing and you compare it to derivatives markets, with factor investing, questions about the impact of AUM growth and changes in the market are hard because maybe you can measure the inflows, but like you can't necessarily measure. You can look and say, oh, value hasn't been working as well, or you can look and say quality hasn't been working as well, or whatever it is, but you don't have an intermediate point to point to. Is it luck? Is it size? Is it what? How do you really prove this stuff out? In derivatives, you can just go look at the price, right? Because we have vol surfaces, and when everybody comes in and does a particular set of trades, it just changes the vol surface, right? So I think we know how to do screen share. Maybe Scott Maidel can pull up.
I'll try to bring it up. Yeah,
the term structure by regime. Scott, I think you know which one I'm talking about. But when you think back of what did the equity index volatility term structure look like in the pre-08 regime versus recently versus some other regimes. First of all, if you go back to what the world used to look like when things were kind of quiet outside of a crisis environment, like that 2002 to 2007 regime, that's the blue line there. Vol term structures used to be kind of 15 or so in front, some mild upward slope, and then relatively flat out to the back, right? Then you had, of course, 2008, and vol went up a lot, and we all remember those days. 2009 to 2012, you had this post-GFC elevated risk premium environment. But then really where we've come back into now in this red line, right, compare the red line and the blue line, right? 2013 to 2021, broadly speaking, is a normal markets rallying. We had the COVID crash, which was obviously a very big deal, right? But it was relatively brief, right? And the term structure is way lower in front. There it's showing 12 on average, but that's including like the COVID period, right? The sort of normal state in quiet markets now is short dated S&P vol is 7 or 8, and then extremely steep out the term structure, and then a little bit flatter out in the back, right? And it's just a massive rotation of the whole term structure relative to what option markets used to look like. And everybody goes and looks at these 30 or 40-year back tests that the consultants bring them or the asset managers bring them or whatever of like what option selling used to look like back when nobody sold options on the blue in short dated in the blue line there. They like look at this great volatility risk premium. But that's not, but then we just changed the price, right? Because then we brought large public pension funds meaningful allocations to short-dated call overwriting and cash-secured put selling and so forth, and we dramatically rotated the term structure and steepened everything, and people are selling short-dated calls at 5 vol, right? It's just a different world, and you can see that intermediate input, as opposed to, again, in some of the delta one factor investing where you can see the returns and you can argue about it, and you can try, like AQR does some stuff about looking at the valuation of different factors and trying to see if that's changed. But it's harder. Here you can just literally see the price.
And even though we've seen these selling volatility blow up once or twice in the last few years, are we still seeing the large institutions continue to practice this?
Sure. I mean, selling volatility is sort of almost a word it's so broad that it always gets massively misused, right? Like people blew up doing wild over-leveraged tail risk selling. Nobody blew up doing call overwriting, right? I mean, call overwriting programs are just another line item in a public pensions, 50 line item thing that like kind of has been underperforming what they've been told that it should perform for the last 7 or 8 years. But like, that's, it's a very unrisky thing, right? It's just equities with less upside.
But yeah, I would just say like the blow up, which isn't really a blow up, is really the fact that the market may sell out a lot. You restrike your option, the market then rebounds swiftly, much more swiftly of current day than historically speaking. The old saying was the market takes the elevator down and the stairs back up. And today it seems to be the elevator both ways, right? So you're capping your upside as the market sells off, you restrike your options potentially, market rallies back and you're capping your upside, but there's certainly no like blow up risk.